In 2022, a 62-year-old investor sat down to review their retirement portfolio, $1,500,000, saved over 40 years, 3 years from retirement, everything in stocks. No bonds, no buffer, no protection. By December 31st, that portfolio was worth $1,228,500, $271,000, gone in 12 months. Not because they picked bad stocks, because the S&P 500 fell 18%, and there was nothing in the portfolio designed to absorb it. No income, no cushion, no floor. And here's the part that makes this genuinely dangerous. That investor is not unusual. According to Vanguard's 2026 data, the average American aged 55 to 64 still holds 64% of their retirement savings in equities, with almost nothing in bonds. 3 to 10 years from retirement, with no protection against exactly what happened in 2022. Most people think bonds are boring, old-fashioned, a drag on returns, something your grandparents held and you don't need anymore. Today, I am going to show you why that belief is one of the most expensive financial mistakes you can make. Not with opinions, with 150 years of data, real crashes, real numbers, and the retirement math that most people never see until it is too late. Let's start with where American investors actually are right now, because the numbers tell a story that should make anyone approaching retirement genuinely uncomfortable. Federal Reserve flow of funds data shows that U.S. household equity exposure has climbed to historic highs. In 2010, households held about 28.5% of their financial assets in equities. By 2015, that had climbed to 34.2%. By 2020, it was 39.8%. By the end of 2025, 47.61%. Nearly half of all household financial assets now sitting in stocks. And the bond allocation? Shrinking continuously for 15 years. This is not a coincidence. It is the product of a decade of low interest rates making bonds look unattractive, combined with a historic bull market making stocks look like the only game worth playing. The financial media called bonds dead, investors agreed, and quietly, without most people noticing, the fixed income buffer that historically protected retirement savings from catastrophic losses almost completely disappeared from American household portfolios. The result is a structural vulnerability sitting inside millions of retirement accounts right now, invisible until the next major shock arrives. And here's the uncomfortable truth about that vulnerability. The people most exposed are not young investors with 30 years to recover from a crash. They are the 55 to 64-year-olds, the people 3 to 10 years from the finish line, the ones who can least afford to absorb a 50% drawdown and wait a decade to recover. That 64% average equity exposure for pre-retirees is not aggressive investing. It is sequence of returns risk, sitting quietly inside tens of millions of retirement accounts. But before we talk about what bonds actually do, we need to talk about what happens when they're not there, because history ran this experiment for us multiple times, and the results are not subtle. Let's go back to the worst financial crisis in American history, the Great Depression, 1929 to 1932. The U.S. stock market collapsed by 79%. Nearly 4 out of every $5 invested in equities simply disappeared. Families who had saved their entire lives and put everything in stocks watched decades of accumulated wealth evaporate in 3 years. Now, here's what most people never learn about that period. An investor holding a balanced 60-40 portfolio, 60% stocks and 40% bonds, experienced a 52.6% decline. Still catastrophic, but critically, they preserved nearly 1/3 more of their wealth than the equity-only investor, and they recovered to previous highs years ahead of the pure equity portfolio. Move forward to the 2007 to 2009 global financial crisis, the S&P 500 experienced a maximum drawdown of 54.7% over 42 months, 4.5 years of losses. The 60/40 portfolio's maximum drawdown was limited to 35.1%, and the recovery time was 27 months versus far longer for the equity-only investor. Think about what that recovery time difference means in practical terms. A retiree with no bonds who needed to withdraw $50,000 per year during the 2008 crash was forced to sell stocks at the worst possible price to fund their lifestyle. Every dollar withdrawn during the trough locked in permanent losses. The portfolio never fully recovered for many of them. The 60/40 investor had bond coupon payments flowing in every month. They could fund withdrawals from bond income without touching depressed stock positions. They rebalanced, buying cheap stocks with bond proceeds while equity investors panicked and sold. They recovered in 27 months. That is not a small difference. For a retiree, the difference between 27 months and 42 months of recovery time is the difference between a manageable setback and a permanently impaired retirement. Now, I know what you're thinking. What about 2022? Bonds got destroyed in 2022. If bonds were supposed to protect me, why did they fall 13% at the same time stocks fell 18%? That's the counterargument everyone brings up, and it deserves a direct answer. 2022 was genuinely unusual. The Bloomberg U.S. Aggregate Bond Index fell 13.01%, its worst calendar year return on record. At the same time, the S&P 500 fell 18.18%. Both asset classes declined simultaneously. The traditional negative correlation, the fundamental reason people hold bonds in the first place, broke down completely. And here's where recency bias becomes genuinely dangerous, because investors looked at 2022 and concluded that bonds are permanently broken, that the old rules no longer apply, that a 100% equity portfolio is the only rational choice. Here's what actually happened in 2022. The Federal Reserve executed its most aggressive rate hiking cycle in over 30 years. They raised rates from near zero to over 5.25% in less than 2 years. When rates rise that fast, bonds prices fall. That is not a failure of bonds as an asset class. That's simple mathematics. And it's a one-time repricing that created something that hadn't existed for over a decade: yield. By 2026, the 10-year Treasury yields 4.40%. Investment-grade bonds approach 5%. The real yield, adjusted for inflation, on 10-year TIPS is 2.23%, some of the highest real risk-free yields available since before the 2008 financial crisis. The 2022 shock did not kill bonds, it reset them to fair value. And at fair value, bonds are now doing exactly what they're supposed to do again: paying income, providing a cushion, absorbing volatility. And here's the number that puts 2022 in proper perspective. In 150 years of financial history, going back through the Great Depression, 2 world wars, the stagflation of the 1970s, the dot-com crash, and the 2008 financial crisis, 2022 is the only period where a balanced 60/40 portfolio experienced a more prolonged recovery than a pure equity portfolio. One period in 150 years, and that period is already over. The 60/40 portfolio recovered fully in June 2025. But the most important argument for bonds has nothing to do with crashes. It has to do with the specific mathematical danger that hits you at the worst possible moment, right when you stop working and start drawing down your savings. And almost nobody understands this risk until it has already done its damage. The single most dangerous financial concept most people have never heard of is called sequence of returns risk. Here's how it works. Imagine 2 investors. Both retire with $1 million. Both average exactly 7% per year over a 30-year retirement. The only difference is the order of those returns. Investor A gets good returns early and bad returns late. Investor B gets bad returns early and good returns late. Despite identical average returns, Investor B runs out of money years before Investor A. Why? Because Investor B was forced to sell depreciated assets during the early bad years just to cover living expenses. Every withdrawal during a downturn locks in permanent losses and reduces the base that future gains can compound on. The math is irreversible. Now look at what Morningstar's research shows about safe withdrawal rates. In 2021, a new retiree with a 100% equity portfolio could only safely withdraw 3.3% of their portfolio per year for a 30-year retirement with a 90% probability of not running out of money. On a $1 million portfolio, that is $33,000 per year. That 3.3% rate is not enough for most people to live on. The balanced portfolio in 2025 supports a safe withdrawal rate of 3.9%. That is $39,000 on the same $1 million, a difference of $6,000 per year. And across 30 years of retirement, that gap compounds. The bond-inclusive portfolio does not just protect against crashes, it fundamentally changes how much income your savings can safely generate for the rest of your life. And here is why that gap exists. In a pure equity portfolio, a bad early sequence forces the retiree to sell stocks at depressed prices to generate cash. In a balanced portfolio, the bond allocation provides income through coupon payments. The retiree draws from bond income without touching equity positions during downturns. The stocks are left alone to recover. When they do, the portfolio is intact. That is the structural function of fixed income in a retirement portfolio, not just crash protection, continuous income that prevents forced selling at the worst possible time. Let's get specific about the tools. U.S. Treasuries are the foundation, issued by the federal government, backed by the full faith and credit of the United States. Interest income is subject to federal tax, but exempt from state and local taxes in all 50 states. The 10-year U.S. Treasury currently yields 4.44%. The 30-year yields 4.86%. Treasury inflation-protected securities, TIPS, are the inflation hedge version. The principal value adjusts semi-annually based on changes in the Consumer Price Index. The real yield on 10-year TIPS currently sits at 2.23%. That means guaranteed purchasing power preservation plus 2.23% above inflation. For anyone worried about inflation eroding their retirement savings, TIPS are the direct solution. Municipal bonds are where the tax math gets compelling for high earners. Here's a number that will surprise you. A high-income investor in New York City facing combined federal, state, and local tax rates approaching 47.7% receives a municipal bond yielding 3.5%. The tax equivalent yield of that bond is 6.57%. To match that after-tax return with a taxable corporate bond, you would need a corporate bond yielding 6.57%. That's the hidden power of munis for anyone in a high tax bracket. The headline yield looks modest. The after-tax return is exceptional. Investment-grade corporate bonds sit between treasuries and equities on the risk spectrum, currently approaching 5% yield for high-quality issuers, fully taxable, but providing meaningful income with credit risk that is manageable for investment-grade names. The key insight across all of these instruments is this. After the 2022 rate reset, bond yields are at levels not seen in over 15 years. The window that existed from 2008 to 2022, when bonds yielded almost nothing and the case for holding them was genuinely weak, is closed. The yields now compensate investors properly for holding fixed income. Let's pull this together. The average American aged 55 to 64 holds 64% of their retirement savings in equities with almost no bonds. They're approaching the most financially vulnerable period of their lives, the years where sequence of returns risk is at its peak, with almost no cushion. History ran this experiment 150 years. The Great Depression cut equity losses nearly in half for balanced investors. The 2008 financial crisis reduced the maximum drawdown from 54% to 35% and cut recovery time from years to 27 months. A 62-year-old with no bonds lost $275,000 in 2022 alone. Yes, 2022 was painful for bonds, but the reset that caused that pain created something that didn't exist for 15 years: real yield. The 10-year Treasury at 4.44%, TIPS at 2.23% above inflation, municipal bonds delivering tax equivalent yields above 6% for high income investors. The safe withdrawal rate research is unambiguous. Across all scenarios and all time periods, a balanced portfolio supports higher sustainable income than an equity-only portfolio, not because bonds outperform stocks, but because they prevent the forced selling that permanently impairs the equity portfolio during retirement downturns. The case for bonds is not about getting rich, it's about not going broke at the worst possible time. But here's the question this video did not answer. If bonds are this important, why are the people who understand markets best not using traditional bonds at all? Because the wealthiest Americans, the family offices, the institutional allocators, the ultra-high net worth individuals who have access to the full toolkit, they're not buying treasury bonds for their fixed income exposure. They're using something else entirely. Instruments that deliver bond-like stability with equity-like returns, no interest rate risk, no inflation erosion, and in many cases, no taxes at all. Private placement life insurance that compounds tax-free, litigation finance generating 15 to 30% completely uncorrelated to any market, farmland delivering 9.6% annualized returns over 20 years with a standard deviation of just 6.3%. The wealthy figured out that the function of bonds, stability, income, non-correlation, can be delivered by entirely different instruments, instruments that most retail investors have never heard of. That's exactly what the next video maps out.